Hi, I'm Khleif. Each and every week, I record an interview with a thought leader that I know you're going to get a ton of value from. Now, here on YouTube are the video versions of my podcast, Lifetime Cash Flow Through Real Estate Investing. Now, to make sure you get the latest information, please subscribe and hit the notification bell. Let's get started. Welcome to another edition of How to Build Lifetime Cash Flow Through Real Estate Investing. I'm Khleif, and I am thrilled that you're here. And I know you're going to get tons of value from the young gentleman we're interviewing today. His name is Zach Haptonstall. And Zach, he's only 28 years old, and he has done a lot in those 28 years. So he's going to motivate a lot of people today. Super excited to have you on the show, brother. Welcome.
Hey, thanks, Rod. I really appreciate that opportunity to be on the show, man. Thank you very much.
Absolutely. So Zach, you've got over $35 million worth of multifamily. Talk about just briefly your foray into this business. How it came about, and a little bit of your background.
Yeah, sure. So I was born and raised here in Phoenix, Arizona. Pretty much lived here my entire life. I lived in Colorado for a bit on a football scholarship. Realized I wasn't going to make the NFL. So I came back to Phoenix. I wanted to be a sports reporter, so I got a journalism degree from Arizona State here, and I was actually a live news anchor and sports reporter on Arizona PBS for about 5-6 months, and I hosted a show on Fox Sports Network Arizona, which was cool at first, and then I quickly realized you don't make any money doing that. You work crazy hours. It's very political. I was like, man, I don't want to do this. So I actually got a job in healthcare sales, so hospice marketing of all things. I don't know if you're familiar with hospice care.
Well, of course. Yeah. I mean, it's not a word I hope I have to experience for another 30 years, but.
Right. Yeah, exactly. Yeah. So basically mobile nursing and caregiving for people with end of life illnesses. So my job was wake up in the morning, drive all around Phoenix and just cold call, walking into hospitals, doctors' offices, assisted living, et cetera, build relationships with physicians, social workers. And when I had somebody who needed hospice, they call me. I'm the first person to meet with that patient and family. So anyways, long story short, it sounds kind of weird, but hospice is a extremely competitive and lucrative private business industry. So I was very blessed to do well in this industry in Phoenix. And I quickly became the director of marketing and then a co-owner in the company. So by the time I was 23, I was making over $200K a year. I bought a house. I was making more money than both my parents combined. Got my MBA, paid off all my school. So I was blessed to be doing well, but I did that for a little over 4 years, and I just got burnt out. I was working crazy hours. I had achieved all the goals, and I was getting taxed heavily on commissions. And so I was like, man, I don't want to do this. And so I didn't know what I wanted to do, though, but I didn't have any time to figure it out. So last year, January of 2018, I just said, screw it. I said, I gotta figure something out. So I resigned, and I sold my equity in the company with no plan at all. I just knew that I wanted to create passive income somehow. And I don't have like a rich uncle. I didn't know anybody in real estate or anything like that. So I literally just said, okay, I'm going to live off savings for the next 12 months, cut all my personal expenses down and figure this out. And so I just started to absorb as many books, podcasts like yours, Rod, all the content I could. And I started cold calling people. I was originally looking at mobile home parks because I like the cash flow vehicle of that. I cold called over 90 mobile home park owners here in Phoenix. I tried to buy one or sell or carry. It didn't work out. I kept learning. I learned about multifamily and syndication, and that was very appealing to me just because I had a network of physicians and healthcare business owners who also hated their lives like I did, but they couldn't get out of it because they have families. And so anyways, long story short, 10 months go by. I'm just burning through money, making no money, lost all my confidence, my sense of direction, my identity. I was like, what am I doing? Like waking up every morning trying to figure out how can I move the needle. And fortunately, in October, we found a deal. It was a 36-unit deal, $3.4 million here in Phoenix. And I had met a guy named Robert, who I'd partnered with at this time, and he's high net worth, high liquidity, also trying to get into the multifamily game. So I'm not high net worth or high liquidity. I had a couple $100K at the time. And so I found this deal. I said, okay, this deal pencils, man. We got to go for it. So we put it on an offer. The offer gets accepted, and we're like, oh, crap, what do we do now? And so we're both 25K hard under contract. And long story short, I put all the money I had in there, 160K, and we figured it out. We brought some people in, and we actually did a tenant in common, a tick structure, not a syndication. So we closed.
Right. I want to stop you for a minute,
Sure.
Okay? Because you're getting into stuff that I want to drill down on a little bit, and I want to circle back to a couple things you said. Now,
Sure.
now you're a licensed real estate agent as well, correct? You got your license.
Correct. Yeah.
Was that had you done that already? Was that after what you just?
Yeah. Good question. I got my real estate license in 2016 while I was still in the thick of hospice as a backup plan. I had never used it, Rod. So I had never used it even up. I've only sold a couple homes for family. That's it.
Right. And so, you know, you've said a lot of things, and I want to chat about a couple of them real fast. So your background really is sales. I mean, you're good at sales. That's what you did with the hospice. So that's your, you know, that's a superpower for you. Now, how's your analytical ability? Would you say you're analytical as well?
I can understand things. I'm no idiot. I have an MBA. I understand the accounting and the underwriting, but I hate doing it, Rob. And so the first deal, I underwrote it. I don't like to sit in front of spreadsheets for hours. I can do it, but it's not my strength and it's not my passion. And so that was my biggest challenge, was I needed to find a complementary partner who's good at that.
That's why I asked the question. And so that's what you found in this gentleman you mentioned a moment ago?
No, not necessarily. So that was not his strength. So I did all the underwriting initially on that deal, but afterwards, basically in that deal, it was a scary deal. We got our proceeds cut, $227K, 3 days before closing. I brought in another guy. His name is Bikram. At the last minute, he invested a bunch of money. He's a CPA, lives in Orange County. After that, we partnered up, and I found my superpower CPA, and he is our underwriting guy.
Perfect. That's exactly what I've done as well. You know, I have a Robert. Robert's a CPA, done, gosh, I think he's been involved in over $1 billion in deals, and he's the analytical side. So fantastic. And the reason I bring that up is that's such a common dynamic, and frankly, recipe for success when you combine the outgoing personality like you with the more analytical personality. You know, watch out. That's success is inevitable in that scenario. The other thing I want to mention is, you know, you're willing to do what other people aren't willing to do. You're out there cold calling mobile home park owners. So talk about, you know, in fact, I want to circle back to that. I want to circle back to how you found these deals that you've done right now. But the other thing I want to mention is, so you were selling doctors and you're selling, you know, you're in the healthcare profession. Those people have money. And so guys, those of you listening, don't underestimate the power of your network and your ability to raise equity. Now, obviously doctors are the belle of the ball in that regard, but there are lots of, you know, other trades where people have money and they'll surprise you. So you realize the benefits of that network, obviously, and you're capitalizing on that. I'm sure we're going to hear about that, but, all right. So please continue. So you found that deal, and the lending institution lowered the loan amount. So they lowered your proceeds, and the 11th hour, what happened?
Yeah, so yeah, it was pretty scary. We had our proceeds cut, $227K, 3 days before closing.
Wow.
So and that was on a Friday afternoon. So like I spent Saturday morning just pounding the phones, like all the people I had met throughout the last year, asking them. And so I found Bikram, put in $150K, and then my other partner, Robert, brought another guy in for like, I think $77K. And so we were able to, fortunately, we closed that gap and we were good to go. And since then, it's been a good property. So that was a scary closing. So, and that was an on-market deal, right? I know you said you wanted to ask how you found that was on the market.
Okay.
And we jumped on it. Okay. And then, so we kept pounding the pavement. We got second place on another deal shortly after that. And then
how'd you find that deal?
The second one. The second deal was also on market.
Market.
By a broker. And this is a good point, Rod, is that, so what I've realized is that you need to, when you're trying to find a deal and create these broker relationships, I was first intimidated by the brokers and I was scared of them because I feel like, okay, I don't belong in this industry, and they're going to think I'm an idiot or I don't belong. And so, but you have to get out there, because what you have to realize is these brokers, they want to set up tours so it shows their seller that they're marketing the property. So they are actually motivated to crank tours. And so when we're looking for a deal, I'm trying to tour at least 3 to 5 deals a week. And a lot of these deals, Rod, I don't even like them. We know that they don't pencil, but I'll go in there, act like I'm taking pictures. I'll read the OM and sound educated about the deal so that I can ask the broker hypothetical questions and then wait a day or two, say, hey, Mr. Broker, we don't like the deal for this reason. So it's funny because this was a perfect example. There was like a 300 unit deal that we knew at this point we couldn't raise the equity for, but we toured the deal with the broker and we told the broker, like, yeah, this area is kind of crappy. We don't really like it. And he's like, well, I got I have a portfolio of 2 deals that are just hit the market. We're like, we didn't get your email. So we drove straight to the 2 deals. It was a 59 unit deal in Scottsdale and a 76 unit deal in Phoenix. And we walked like, these are really nice. We underwrite the deals and sure enough, they pencil. And we thought they had made a mistake because like it's so hard to find a deal that pencils first pass. Mm-hmm. So anyways, we put in an offer. we had a really aggressive terms, and we can talk about that if you want, but we get that under contract, and we were kind of creative. The guy wanted to sell both properties in 1031 exchange into one property. And the way we made it pencil is we syndicated the 76 unit with the 506B syndication. We did another TIC, tenant in common structure, on the 59 unit deal in Scottsdale. We gave the guy his combined price of $13.5 million, and we won that deal. All
right, so let's dissect that for a minute. Okay, so you did a 506B. So guys, those of you that don't know that, there's a 506B and a 506C. The 506B requires you to have a substantial relationship with the investors that you bring into that deal. And there are a lot of people abusing that entire dynamic in the 506B world. But what I'm even confused about here is why the TIC was relevant on the other property. So please explain that. You used your own money? You did a TIC because you brought your own money in? Is that what you did?
Yeah. So what we did is, it was a smaller deal, and it was like a $7 million deal. And I'm sorry, it was 6.1. The other one was 6.9. So this one was 6.1. And basically, this was one escrow, Rod. So both deals were under one purchase contract, and the economics of the underwriting worked out better for us to do a TIC. Okay. And by the way, I'll do a disclaimer. I'm not an attorney, but we passed through all this with their attorney for TIC.
All right. So explain the structure.
So basically, with a TIC structure.
By the way, TIC means tenants in common, guys. Okay.
It means tenants in common. So let's say Rod and Zach buy a deal, okay? And you have $900K, Rod, and I have $100K. Well, you're going to create an LLC, and you're going to be one tenant in common. So you have a TIC LLC. I'm going to create an LLC, and I have a tenant in common. So I
got you. So you didn't syndicate the second deal. You did it effectively as a joint venture. Is really what you're saying.
It's basically a joint venture. We brought guys in at $500K minimum. So we had a handful of people. And this is an A location, Rod. It's hard to find deals in Scottsdale. The plan is to hold it for 20 years and keep refining it. Whereas, as you know, a syndication, they're basically flips, right? Like 2 to 5 years.
Well, not all of them. I mean, our syndications, we plan to refi and build legacy assets on some of them as well. But I got it now. So it was such a sweetheart deal. You were able to effectively joint venture it. And the structure, you did it under a tenants in common, so that when you sell, if somebody wants to roll that money into a 1031 or whatever, they're not limited. Got it.
Yep, 100%.
Got it. Okay, now I understand. Okay, so that is a fairly complex deal to put together, where you've got half of the deal is a syndication, the other half's a joint venture like that. So got it. Yeah. Okay, awesome. Well, great job on that, man. And when did you take those down?
So we got them under contract in April, and because the seller wanted to sell them both in 1031 exchange, he had put in to the contract 2 30-day extensions, and he ended up exercising everything. So this was a 120-day escrow, 4 months. We closed on them both August 9th of 2019.
Wow.
Okay. And so we had those.
Congratulations, man. That's fresh. That's newlyweds. Awesome.
No, yeah, thanks, Rod. I appreciate it. So we had pretty much finished our raise in 50 to 60 days. We were done just waiting. So then we were under contract on those 2 deals, that portfolio. We found another deal. 137 unit deal. It was a $17.5 million deal here in Phoenix. And we underwrote that, and it was on market again, and it penciled. And we're like, wow, is this a mistake? It wasn't. We dialed in the numbers, and we were very aggressive with hard money day one, and we can go into that if you want to.
Yeah, I do okay. Actually. But well, let's go there now. So you said, you mentioned that on these other deals as well. You were very aggressive. So you went hard right out of the gate.
So on the portfolio, the 2 deals we just discussed, there was 14 different buyer groups putting in offers, okay? And some were trying to buy one or the other asset. The seller ideally wanted to sell both. And so I'm in the broker's ear trying to get some type of guidance. So the way we structured it, we did a 10-day access agreement upon accepted LOI. So we get an accepted LOI, and then we're not under contract. We get a 10-day access agreement where we do our full due diligence, okay? So we do a full
every unit?
Every single unit. Yep.
Wow.
And Robert and I personally each walked half the units. So we split into 2 teams, and we split each property into 2. So it's a full due diligence, not under contract, but you're under access agreement. The reason sellers and some brokers do this, Rod, as you know, is so that you don't get retraded. They don't get retraded because the deal's not under contract. So basically we go in there, both properties were pretty clean. They had new roofs. We asked for a $65,000 credit, which they gave us. So after that access agreement, we signed the PSA, okay? After 1 day after signing PSA, we went 400K hard.
Wow.
Okay. That money's gone. And
Right.
it seems crazy, but Phoenix is just a very overheated market and these assets are hard to find.
You already did your due diligence for the most part.
Right.
So, you know, the only risk there is the financing, you know, or the raise, your ability to raise. So, you know, and I'm not going to suggest, there are a lot of things that Zach has done here that I'm not going to suggest those of you listening do. For example, quit your job and live on savings.
Yeah, it's not necessary. Yeah, it's an extreme example. It sounds kind of cool, but it's not absolutely necessary. I had kind of burned my ships and was ready for a new thing, and I was blessed to have money that I could actually live off of.
Right.
But you don't have to do it.
Right. And but see, even that could have ran out. And guys, when you do that, then fear creeps up, and fear is paralyzing. And so if you're worried about how you're going to, you know, survive over a period of time, it's going to slow you down. And so I never recommend that. But you made it work, man. My kudos.
And to that point, Rob, I think that's what people don't realize is that, like, you do have to have liquidity at some point to do these deals. So there was a few of us, and I had to put up 100K hard for that money. Well, I had put all my money into the last deal, right? Well, I had bought a house in 2015, and I was thinking about it, and I told Grace, my fiance, I said, we have to unload this house. Like, we're sitting on over 100K of equity. So I actually sold the house and had like 120K money come from it. And the next week, I wired 100K hard into that portfolio deal. So I really was all in, and we were fortunate, but we had a full inspection, like you said.
Well, let me say this though, buddy. You know, you can bring in people to put up the at-risk capital. So yes, you say you need liquidity. You need access to liquidity. Okay, you don't necessarily, it doesn't have to be out of your pocket. There are people that will take a piece of a deal to put up the at-risk capital, piece of the deal to, you know, and the at-risk capital being the earnest money, the inspection costs, the third-party reports you're going to pay for with the lender, things of that nature, you know, all of which they'll get back from the deal. But it is, you know, the operative word is risk, the at-risk capital. But there are people that'll do that if they have faith in you. You know, I circle back to a couple other things here real quick. One is, you know, the fact that you were aggressive. I mean, you again, on the money hard day one, guys, if it's your first deal, please don't do that. Okay. I want to caution that. You know, I know you had quality people around you. You had, you know, you know, and you're an anomaly in that regard. That
yeah, we didn't do it on the first deal, Rod. To your point, we did not do hard money day one on the first deal. It was just traditional 21-day due diligence, and then
so you understood the business, you know, a little bit more, and all that. Okay, fantastic. The other thing I want to draw attention to that I think we glossed over is, unlike most people, you went straight to multifamily. You didn't waste time with houses. I mean, you told me the only house you owned was the one that you just mentioned that you sold to raise some equity that you lived in. Why? Why'd you go straight to multi?
Yeah, that's a good question, Rod. And I'm not like Superman or crazy or anything like that. Like, this was a scary thing. And this was a whole evolution of my mind and my emotions from January until like October of 2018. Cause keep in mind, I didn't know anything about multifamily or even investing really. I literally would wake up every day and say, how can I move the needle today? So I was absorbing as much. And the more podcasts I listened to and the more books I read and the more people I spoke to, I just realized that there's so many people who are saying, oh, there's guys who are syndicating thousands of units, and people ask them, well, if you could go back, what would you do differently? They would all say, I wish I would have started bigger earlier. And so for me, I kind of got to the point where I was like I said, like I didn't have a lot of confidence, man. I was like, what the hell am I doing each day? So I got to the point where I was like, screw it. I'm just going to go all in. I don't want to start with a duplex or a fourplex. I had tried to buy an eightplex a couple months earlier. It didn't work out. So when we found the 36 unit, I was like, let's go all in. And this is a scary process, but if you have the proper education, the team around you, then you can mitigate a lot of that risk. So I don't want people to do crazy things. I'm not
sure
condoning that. But.
No. And that was all, you know, really well articulated. And by the way, guys, those of you listening, I've now got what I call a multifamily property toolkit, tool book on my website, 66 or 67 pages long. Every possible question you would want to ask that I can think of if you're looking at a property. And I spent a lot of time on this, and it's free on my website. So for God's sakes, go download it. We use it to make sure we don't miss any questions, because that's the beautiful thing about this business. If a deal pencils out, it's primarily, the bottom line is this business is primarily empirical. It's primarily numbers. So if it pencils out and you ask all the right questions, it's pretty hard to screw up.
Right.
So, I mean, you really have, you know, so definitely download this toolbook. It's absolutely worth it. You'll really appreciate that as a resource. But that said, the other thing so you went straight to multifamily, let me ask you a question, because you are, you're a fire ready aim guy like I am. It's a lot of what you're saying is resonating with me as well. What drives you? What's the motivation here?
Yeah, that's a good question. I'm really not motivated by like money or real estate. Like real estate is cool, but I don't love like buildings. You know what I mean? I've never been into that. I like that it's a good vehicle. For me, I haven't really, I feel like it is, like in all humility, I feel like it is my destiny or fate to have a major impact. And I think it's going to be a combination of like through socially media and business. And so my whole goal is to basically create the financial freedoms as a vehicle to do other things. So I have time, because when I was making over $200K a year, at first I thought I was a baller, like it was my early 20s. And then you realize that's like empty, you know what I mean? And I hit a ceiling and you're getting taxed heavily. And so, I mean, my goal is to just create passive income to free up my time so I can pursue other things. And I know that's a very abstract answer.
No. Actually, I think I know where you're going. I mean, I see you as a thought leader, man. I totally see you up in front of rooms of hundreds or thousands of people, adding value and helping other people. I totally see that for you. If that's kind of what you're insinuating, because
thanks. Right, it is. I like to bring value to people, and I like to positively influence them, and I don't want it to be about me. And I think we talked before the show, like I'm not big into the gurus and stuff like that.
Right.
And this is one point, I don't want to get off track here, but this is one point I want to tell people, Rod, if you'll let me, is that I think you have to be careful, to your point about multifamily right now, because a lot of it is like attention-seeking behavior. I personally hate social media because it's like fear of missing out, attention-seeking behavior. And with multifamily, you have a fiduciary responsibility to your investors, like to do a good job with asset management. And right now, there's so much, like if you acquire a deal, you're an expert. You get on some podcasts, you're an expert. And so I tell people I'm not an expert. We haven't even gone full circle on a deal yet. So yeah, you have to just.
Well, and right now we are also in irrational exuberance, and I've saw it in 2006 and 7, and we're there. And so, there's going to be some pullback. I don't know how significant. Who knows? If I did, I'd already be on my yacht. I was looking at yachts yesterday at the Fort Lauderdale Boat Show, so that's not top of mind for me. But so let's also talk about something else. You're a real estate agent, and I get asked this question all the time. Should I get my real estate license? And my answer is always the same: only if you're going to do that as your business. You're going to help people buy property for a commission. Otherwise, it's actually a hindrance. And the reason it's a hindrance is you're held to a higher standard. So you're not held to the same standard that someone that's not licensed is held to as to how you operate in the real estate realm. And it's just unnecessary. It's not going to make you any money unless, again, you're going to sell. And because, I mean, me personally, I still own a real estate company. Actually, right now, I own a real estate company. I have a broker on my payroll, so I have access to anything I need. Any commission on any deal that I own goes into the company, which I own. So, it's mine anyway. So, it's unnecessary. But let me see what else. Oh, I know what I wanted to ask you about. So, you and your fiance Grace are a team, yes?
Yeah, we're a team. And so Grace is like our director of marketing and investor relations. She's a machine with all that stuff. So like I said, I sound kind of hypocritical here. If people have seen, like we do have a decent presence on social media, and it's all Grace. Like I'm not good with that stuff. I hate social media. Honestly, I just don't really like it, but it's a necessary evil if you want to be in the industry, because you have to gain exposure. You have to gain perceived credibility to raise money. And so yeah, Grace is constantly setting up calls with people, like on a Calendly. So I try to have calls every night if I can, or during the day. She's constantly putting out content, doing videos, things like that. So I don't have to worry about that, because I think if you want to get into the business, and this kind of ties into your point about being a real estate agent, is like you can't do 1,000 different things. Like multifamily is hard, so you need to focus on that one thing, make that your one thing. And so if you're too caught up with like doing marketing on Facebook and this and that, it just distracts you. I want to focus on doing the deals. And even for our meetup, we host a multifamily meetup here in Phoenix. All the credit for that goes to Grace as well. She does all the logistics as far as setting up the venue, lining up the sponsors, catering the food, doing all the online registration. All I do is try to find speakers, and I usually procrastinate, right? I wait till like the day of to write the questions, and then it's just like a content-based thing. So yeah, so Grace, I couldn't have done this without Grace, and just more so, I think it's just important for anybody trying to do this to have that supportive partner, whether that's your spouse, your significant other, or it's a family member, because when you're trying to do this, like for me, I had people telling me, oh, you can't do this. You're crazy. What are you thinking? You left $200K job a year to do this, making no money. But Grace was always there to have my back.
Well, let me say something to what you just said. All those people that told you that were speaking out of fear. Okay. 100%. Those were fear-based concerns. And guys, that's why we talk about this when I talk about how important, your peer group is, because who you hang out with is who you become. And as you elevate yourself and you take risks and you do things that other people aren't willing to do, your peers very often, out of fear of losing you, will tell you you're making a mistake. And it's because they love you, but with their love, they can hold you back. So be very, very careful of that. So I'm really glad you brought that up. And as it relates to you working with Grace, it's awesome that you complement each other and you've each found your little niche. And guys, I will tell you, the wealthiest people on the planet are usually the ones that are in relationship, that aren't out there hunting, trying to find love and whatnot. They've got a great foundation at home. And the fact that you work with Grace, which is very not uncommon. A lot of real estate investors, have husband and wife teams and very successful, but you each have to find your superpower and play to your strength. Like it sounds like you guys are each doing, and that's a recipe for success right there. So
100%.
Awesome.
Yep.
Awesome. So, let's see what else I want to ask you. I love the how successful you are at your age. That's just fantastic. But, let me, what did you have to give up? What did you have to give up? What did you have to sacrifice to get where you are already?
Yeah, so that's a good question. I mean, it was a whole mindset shift, because just in January 2018, when I realized I was going to quit my job, I went from getting fat checks every 2 weeks to burning through money. And so we canceled our TV. I canceled my Spotify membership. I stopped getting haircuts. I just spaced my haircuts out more. Grace's mom started doing my hair. So little things like that. And yeah, it's just making certain sacrifices and being dedicated to that thing. And the biggest thing that I had to, this is kind of a different answer to your question, but the biggest thing that I had to adopt in order to be successful was to be more consistent and disciplined with my habits. And so last year I read a book called The Morning Miracle for Millionaires. And
Hal Elrod's Miracle Morning for Millionaires. Yep.
100%. Yeah. So you're familiar with the savers. And I do that almost every single morning, where I'll wake up, I go into my office, and I'll just do deep breathing. I'll pray. And then I'm Christian, so I believe Jesus Christ is my Lord and Savior. So my faith is the biggest thing for me. And I think growing in my faith during this process helped me significantly. I'll journal, and then I work out and things like that. I meal prep my breakfast for the whole week every Saturday, just so I don't have to worry about that. So it's these little things, Rod, which sounds kind of funny, but it gets my mind right so that I have endurance, mental and physical endurance to overcome adversity. And during the summer, we were under contract for 3 deals, and we raised over $12 million, and it was really stressful. This is scary stuff. And so, but sticking to these habits, it's kind of like giving yourself a mental vacation, because it's okay, I had a rough day, but if I wake up tomorrow and I get my 8 hours of sleep and I hydrate and I do this disciplined habits, then I'm ready to rock again. You know what I mean? So.
It's funny. We had a tough time for me to get going on this interview this morning, because normally I do it as well. And I had a rough night last night. And then I realized that my trainer is coming this afternoon, and we're going to do high intensity circuit. So I'm like, you know what? I'm not going to run this morning. And I just couldn't freaking get going. I had to make my move and hit my chest and wake up just to have some energy for this interview with you. And because, that is so powerful. And my love language is gifts, and my coaching students they all get the Miracle Morning. And, I've had Al on the show here as well, super human being, but it's so powerful to start your day off that way. And I didn't eat my own cooking this morning is my point, because I usually do that as well. I usually exercise and, I do a little gratitude meditation and it's so freaking powerful. And the journaling as well.
It's the key. Yeah. It's the key. It's huge.
Right. So do you have a favorite quote?
Not really, honestly.
No? Okay. All right. Fair enough.
One
Fair enough.
quote, you know what, I'll say this. I learned this quote in high school, and maybe it's tarnished now because of what happened to the guy, but it's a quote from Lance Armstrong. I read a book from his, and it's very simple. It basically said that confidence is earned. So you look at these confident people like Rod Khleif or some of these.
So that's a great quote. Great quote.
And I think about that, like confidence is earned. Like you don't just wake and be confident. Like it's scary. You have to push through the fear and push your comfort zone, and then that will give you confidence to take on the next challenge. And so that's
counterintuitive. It's counterintuitive. You have to push through fear to build your confidence. And so you have to, almost have to fake it till you make it, as it were. And no, absolutely, great quote. And I don't think it's tarnished at all, frankly, but, great quote.
Agreed.
So are there any books that you gift more than others, or any books that you really enjoy, that have helped you on this journey? You mentioned the one thing. I don't know if that came.
Yeah, I read that.
Book.
Yeah.
Okay.
I read the one thing several times. And the thing with me is like I don't actually read books, Rod, because I'm just too anxious. But I do audio books.
Right.
Okay. Every morning when I'm working out, I have Audible and I do audio books. And so there's a bunch of them. I think Think and Grow Rich, which is obviously a classic. I listened to that several times last year when I was trying to cultivate like the faith and imagining it. It's all ties into the law of attraction, things like that. And one book that I listen to almost every morning, and I have it bookmarked different chapters, is a book called, it's pretty mainstream now. It's called Can't Hurt Me by David Goggins. He's the SEAL guy. Awesome. Guy. I have not read that or listened to it, and I need to, because I've heard great things about it. Think and Grow Rich, I've given away, I'm not exaggerating, probably over 3,000 copies. I'm literally 3,000 copies. So tell me about a mistake or a failure. A big one in the lesson, if there was one. There always is one, but. Yeah, I hear you. I guess on the very first deal, one example would be you just don't know what you don't know. And so it was a really rocky, scary thing because we had a seller there was a storm right before we went under contract. We had heard there was some damage to the roofs. We were told by the broker that there was a claim, an insurance claim that would be assigned to us. We got it in writing. It was assigned. But we just didn't do a good job managing our due diligence with the roof inspections because we find out later after our money is hard that there was no claim and the guy completely made it up. You know what I mean?
Wow.
And then right after that, a couple of days later, we realized that there's stab lock electrical panels, which are basically like electrical panels that are built in 60s, 70s.
Oh yeah, you got to change them out.
Yep. You have to change them out. We didn't know. We had no clue about that. And so we had no idea. So when you did your due diligence, you didn't bring a building inspector through. You didn't pay for that. We did, but we just didn't manage it very well. Like I had partnered with another guy who had the subcontractors, and we should have been more on top of it because it was our money. It was our money at risk. And you brought in subs to do the inspections, or you brought in an actual building inspector? Subs. So we didn't. Yeah. Okay. So I guess we didn't. We didn't have like a centralized guy because our PM. We had a smaller PM, Rod. So this PM does like 50 units and below. We didn't know. So now we know like our PM needs to manage all that stuff like they have on our last 3 acquisitions. But on this one, we're like, okay, we call an individual plumber. We call the roofer. Yeah. We call a sewer scope. You know what I mean? So it's like.
But you didn't say electrician.
Electrician, yeah. Yeah, we didn't.
Let me say this.
We didn't know about the panels. And then the insurance.
An electrician might not have even said anything. It's guys critical, freaking critical. You always have a building inspection. I do. And Christ, I mean, I've been around this for longer than I want to admit. And you always have a building inspection. That's a great one, buddy. Thank you for sharing that.
Yeah, no, of course.
So, what else do I want to ask you?
I know you had asked, so I told you about, I don't want to get off track here, Rob, but I know earlier you had asked about the terms for the second deal and the third deal.
Okay.
The third deal we didn't go into, but that's the 137 unit deal, $17.5 million. And so that one is extremely competitive because now when you're in Phoenix,
sure,
we're like with the big boys when we're competing against that. And so on that deal, we did not do an access agreement. We went truly hard day one with no look. We went $450,000 hard, gone day one after signing the PSA with no access agreement, no inspection, which people are going to say that's crazy. which it kind of is, but here's why we
No,
felt.
it's not kind of is. It is.
But here's why we felt comfortable, Rod. Here's why we felt comfortable. Because we gained intel 2 weeks prior with our property management company, used the exact same roofing subcontractor that the seller had. And they had a full roof inspection done like a month or two prior to us going under contract. So we had a full roof inspection, line item expenses, complete with pictures, and called around, and our owner of our property management company, which is a very credible company, said, yeah, we trust this roofer. And so we basically underwrote contingency in there to recoat these foam roofs and retile the issues based on this inspection, and the deal still penciled, okay?
I understand that. But there's so many other ways that could have gone wrong. Okay. I mean, it could have had the electrical situation that you didn't have on your first deal. Could have had, I mean, maybe it was built newer, maybe it was newer. So that wasn't a possibility.
This was an 80s build. So it was all copper plumbing, copper wiring. We checked all the panels during our inspection. I mean, in the 80s,
you did get an inspection. You did get an inspection.
No, I'm sorry. During our tour, we checked a few units during the tour, but they weren't stab lock. And everybody we had asked, there was no stab lock panels in the 80s. Okay. And then we asked our PM, I asked our regional, I said, let's assume the plumbing and the sewers are totally shot, like destroyed.
Well, that was going there next. What if they're collapsed or whatever?
Exactly. What does that cost? And they're like, well, actually, we have a deal that we're managing. This happened last year. It was a disaster. It cost X amount. We underwrote that in as contingency. And the deal still penciled. So we had working capital to absorb all those costs. So we felt confident. And to that point too, Rod, because you're right, it is kind of crazy. But we also requested the phase 1 environmental report that the seller had done.
There's no environmental issue. Yeah, that's a must.
And they gladly gave it to us. And this is an institutional broker. So it's IPA with Marcus and Multifamily. They're very professional. This was a small deal for them, honestly. They gladly gave us the phase 1. We also asked for a clean title report before ever going under contract. They gave that to us. So we knew title was clean. We knew environmental was clean. We knew we're covered on the roofs, the plumbing, and it was an 80s build. So we didn't have to worry about. And
you had good financials. You had a credible financials, credible rent roll. So you knew you were 90 for 90. I'm assuming did you get non-recourse debt?
We did. Yeah. This was a 10-year fixed non-recourse Freddie Mac conventional loan with 5 years of IO. Yeah.
Wow. Nice.
So, and we got lucky. This was a 3.8% interest rate because right after the Fed had announced they were cutting rates, which isn't necessarily direct correlation to the treasuries, but it helped us. We locked in like 2 days after that. So we got a really good loan product. So
that's good.
Comfortable, but we weren't the highest price, Rod, but we had the most aggressive hard money day one. And then we had really we killed it on the interview with the seller because we had done our due diligence. And
Talk about that. Tell us how you killed it.
Sure. So how this works is, like I said, it's extremely competitive deal. You go through your first round of offers are due. Then they had a best and final, which was 5 final groups. And I had been trying to cultivate this relationship with the broker throughout the process. And I just asked him, I said, hey, Mr. Broker, where are we on purchase price, hard money, terms? And he said, you're actually 1 here, you're 2 here, you're 3 here. Okay. So we pushed it where we could. We got into the final 3, and then you do interviews with the seller. This is the best and final round. And so they did 3 interview calls. And so basically I had personally secret shopped all the comps. So we had 5 comps, and our top 3 comps were all owned by the same seller, believe it or not, because they're just a big institutional company. And 2 of those 3, they were using the same property management company that was currently managing the subject property that we were trying to buy. Okay, so we basically just told them and went through all the rents. Like, this is our business plan. This is our working capital. Based on your other deals that you own, you've already completed these finishes and achieved this rent. So all we're going to do is copy what you're doing, and we've already modeled it out. And because we gave them that explanation and we told them that we demonstrated our knowledge of the submarket, they felt confident that we would perform. And we made it very clear too, we are the decision makers. Like, we don't have to get permission from our equity. We personally have our own money at risk. There was 5 of us total. We each put $50K in on the front end. So basically we went hard. We went hard day 1, 250, no look. And then we went 10-day due diligence, okay, which we didn't really need because we needed it, but it was clean. We went hard for another 200. Okay. So we were 450 after 10 days. And so we basically, this is our money. And so they felt comfortable, and the broker told us that's why we won the deal.
Okay. Well, again, those of you listening, high risk. I mean, without, solid,
microscopic building inspection, could be structural you don't see, could be, just things. So just I don't want people to think that they should be out there doing this.
No, yeah, you don't have to do crazy stuff like this, but this kind of gives you, this is what we did and we felt comfortable.
It worked. Yeah, it worked. So, well, listen, you have added tremendous value, brother. It's absolutely a pleasure to meet you. And, I know you're going to inspire a lot of young people listening on the show and even people that aren't young because, it's massive freaking action. Massive freaking action. I love it. So, listen, I really appreciate you being on the show. And guys, I may come speak at his meetup in Phoenix. I think he may have roped me into it. We're going to see if we can get the dates aligned. If so, I'll come down and do that. So we'll keep you posted on that. Anyway, it's a pleasure to meet you, buddy, and I will talk to you soon.
Okay, thanks, Rod. Appreciate it.
Hey, thanks for watching. Please subscribe to my channel. And if you listen to podcasts, join me on iTunes, Stitcher, or wherever you listen to those podcasts. Just search for Lifetime Cash Flow through Real Estate Investing.